Greetings class, Dr. Royer here, and this is chapter 7. Video is going to cover the equity market and stock valuation that we're going to discuss in chapter 7, and we're going to go through how we determine the value of a price of, or how we determine the value or the price of a share of stock. Now, figuring out the price of a share of stock is not always the most obvious thing because there's not a face value on it, and there's certainly not a guaranteed rate of return. And most of the time, well, all the time actually, shares of stock are not going to mature. We don't have any maturity date in the future, so it's going to go on forever. So one of the ways that we do this when we're looking at present value is we look at the present value of future cash flows. So we look at the $10 dividend in this example. We're going to get a $10 dividend, and at the end of the year when we sell the share, we're going to get $70. So we add those two together. That's the future cash flow. Divide it by 1 plus the required rate of return. In this case, we want a 25% rate of return. That gives us a new price of $64. That formula can be used and is a basis for a lot of what we're going to do in this chapter. We're going to look at the price of the dividend. We may add in the price of the share of stock if we're going to sell it in the future, and then we're going to add that to our cash flow, and then we're going to divide that by 1 plus the required rate of return. That model can be used in a number of different periods. So this is the price in the original year. We can move that out to the next year if we look at the dividend in year 2 and the price that we expect to recover at the end of year 2. And that will give us, again, a different calculation for the value of the stock today. We can do that ongoing. We do that forever. We can do that for as many periods as we want, and they show you that here in this model. Another way of thinking about this, we may not want to include the price of the share of stock because we may not know, and we are not going to know what that price will be in the future. But we can calculate the price of the stock based on the anticipated future dividends. So if we say at any given time we can look out into the future and see based on past history what this company's dividends are like, we can project those out into the future. So we could figure out the price of the share of stock in year 1 by just taking the dividend in year 1 divided by 1 plus the rate of return raised to the first power. Now, if we do that in other years, we're going to take the year 2 dividend, but now we're going to raise the 1 plus the required rate of return to the second power. In year 3, we would take the third year dividend, but we're going to raise the 1 plus the required rate of return to the third power. So however many years out it is, that's what we're going to use as an exponent for 1 plus the required rate of return. Typically, we're looking at growth stocks and how they grow. If a stock doesn't grow, we're going to say they have a constant dividend. We know what the dividend will be every year forever. So that would be the computation I mentioned above. We don't have to put a subscript here to indicate year 1, year 2, year 3, because the dividends are all going to be the same, and it will go on forever. Because the dividend is always the same, the stock value can be just an ordinary perpetuity, and where the cash flow is equal to the dividend every period. So per share value can be calculated in this way. We take the dividend divided by the required rate of return. We don't have any stock price to figure in. This is all we have to do. So when we look at that, we could say, well, that's would work out the way this example is here. They show somebody who has a stock that's going to pay $10 per share. Required rate of return is 20%. Therefore, the price on that share would be $50. That's what the price would be. Now, many times, well, I don't know, many times, but there are times where there's a constant growth rate in the dividend. From year to year to year, it may be increased by 5% or 10% or whatever. So whatever that growth rate is, it's constant, and you can actually plug that number in as a constant. That's what they're doing here. The dividend in year 1 is going to be this year's dividend times 1 plus whatever the growth rate is. The dividend in year 2 will be the calculation of the dividend in year 1 here, plus it's going to be multiplied by another year of growth. In other words, you can calculate the dividend in any given year by taking the dividend in the base year times 1 plus the growth rate raised to the power of however many periods you're going out. So if you're going 2 years out, you're going to take 1 plus the growth rate raised to the second power times the dividend. That's the model they show here. So when they do the example for this, they show that right here. You have a $3 dividend. You're going to take 1.08 as the constant growth rate, and you're going to go out 5 years and figure out what that's going to do to the dividend. Well, in 5 years, it'll be $4.41 for the dividend. Now, when we're looking at the price of the share of stock, we're going to look at these dividends as a series of cash flows, and we can write it this way. We can say the price of stock when there's a constant growth rate is the dividend that we have now times 1 plus the growth rate. That's going to be the price this year over the required rate of return minus the growth rate. So in other words, the price of the share is simply the dividend in year 1, which is what this calculation does, divided by the rate, the required rate of return minus the growth rate. This is also called the dividend growth model, but it's easy to use and it's fairly straightforward. So here you have an example where there's a $2.30 dividend. The required rate of return is 13% and the growth rate is 5%. You just plug the numbers in here, and the price in this year for that share of stock will be $30.19. But you can compute that out into the future. You don't have to just do it for this current year. You can take it out into the future by using the exponent. So let's say we want to know what it is in 5 years, the present value of that stock in 5 years. After 5 years of growth, we're going to calculate the dividend. What that will be, it'll be $2.935 after 5 years. But using the dividend growth model, we can calculate the price of the stock by saying, okay, the price in year 5 is going to be the same thing as the dividend in year 5 times 1 plus the growth rate, divided by the required rate of return minus the growth rate. So here you have the dividend in year 5 we computed here, times 1.05, the growth rate, divided by the required rate of return, 13% or 0.13, minus the growth rate of 5% or 0.05, and you get this 3.0822 divided by 0.08. That means the value of the share of stock is $38.53. Now that's assuming that we're basing the value on that growth, on that constant growth. But what if the dividend doesn't constantly grow? Well, wait a minute, let me back up a little bit. This is actually a present value computation. This is what we've been doing up here. Instead of dividend, they're putting in here the C1, which is a cash flow. So basically we're looking at that cash flow. The present value of the share of stock is the same thing as whatever the cash flow is, and in this case the cash flow is the dividend. So that's what we're looking at. Now I was saying about non-constant growth. What if the share of stock earns dividends that change over the years, like this, $1, $2, $2.50? There's not a constant rate of change in that. Well, a constant rate of change, you would see something like this, but this is not. So with non-constant growth, we're going to take the dividend for each one of those years divided by 1 plus the growth rate raised to the power of whatever year we're in. So we're in the first period, it'd be 1, second 2, and 3. And then we're going to add, we'll calculate the price of the share of stock based on this growth rate here. We'd say 52.50. We say, okay, well, we can calculate that. We're going to bring that in here, okay? So when we say, okay, this is the present value of that share of stock, 52.50, we're going to add that into the calculation because that's a part of the cash flow that we're going to get when we sell it, divided by 1 plus the return rate raised to the third power. What you get then is a present value for the share in 3 years. The value today of that return is $43.88. Supernormal growth is unusual growth. It's where you have extraordinary growth rates. This is not typical, but it may be the case in a new company. And again, that model will look very similar to what we were talking about with non-constant growth, where you have each individual dividend divided by 1 plus the required rate of return, raised to the power, whatever year that is. And then at the end, you're going to add in the price of the stock that you are going to be able to sell. You're going to calculate the price of the stock based on that. Anyway, so you have the calculated price of the stock in year 3. So here is the price in year 3. They calculated it using the dividend growth model, it looks like. Put that in here, and you calculate this out. You have the 120.835 from here. And you wind up with a calculated present value of that share of stock that's going to be worth $120.835 in 3 years. The present value is $87.58. So, what are the components of the required rate of return? Well, we've talked about it like it was a fixed thing, and it's not necessarily. We can actually solve for the required rate of return if we look at the dividend divided by the price in the current year plus the growth rate. That will give us the required rate of return. It can also be restated. What they're doing here is they're showing that the dividend yield is actually the dividend you're going to get out of the stock. The capital gains yield is actually the price you get when you sell it. So that's going to be the difference between what you're actually buying it for and selling it for. So that's going to be the change, the percentage that you see. It's not going to be a dollar amount. The capital gains yield is going to be a percentage. So here what we're looking at is a dividend rate. In the example they give you, a $1 dividend at 20%, a 20% capital gain yield. What that means is you've gained $20 capital gain yield. That's what it is. And then plus it's not percent, this is $20. I'm sorry, I misspoke. But $20 gain yield. So if you purchase the stock and you sold it, it's a $20 yield. $1 dividend, that's the dividend yield divided by the $20 capital gains yield plus 10%. $1 divided by $20 is 5%. So the required rate of return in that case is 15%. That's how you calculate that. So we can also then use that required rate of return to go back and calculate the price of the share of stock using the dividend growth model. And so that appears here. So, all right. Now, stock valuation, if you're going to use comparables, you may not value it based on dividends if they're not paying dividends. So you're looking at price-earnings ratio. Basically, what you're going to look at is earnings that a company is what their earnings are divided by the number of shares that they have. So you want to know what their earnings are spread out across the shares. So they give you an example here where you're looking at this one stock and you feel that the PE ratio of 20 is appropriate for a company, and the earnings over the 4 most recent quarters are $2 a share. So you think the stock should sell for, and your PE ratio is 20 times $2, you get $40. You might view that as an attractive purchase if it's going for less than 40, but not if it's over 40. And again, that can change, or the calculations can change. So when you're looking at a price-earnings ratio in the future and you're projecting it out, that's what they call a forward price-earnings ratio. And in a similar example, using the same fictitious company, you're looking at earnings for the coming year are going to be $250. That's a projection, and reflecting the growth of the company. And so given the number you've computed here as an attractive price of the share of stock, you take the forward price earnings ratio. You're going to take the price of the stock divided by what you expect the earnings per share to be, and it gives you a price earnings ratio of 16. The PE ratio of 20 applies to earnings over the previous year, but if you are looking at earnings in the future and you want to see, okay, well, I want that to be the same as it was in the past, the PE ratio, it should be 20 times 250 of $50. That's what you're anticipating. Those are target prices, not necessarily actual. But again, these are projections and they change, and they may or may not be met by the company. So when you look at stock valuation, you can calculate based on dividends. Where you have individual dividends, you can calculate based on a constant dividend where the dividend does not change. And then if you have a dividend growth at a steady rate, you can calculate the value of that share by dividing dividend by the rate of return minus the growth rate. And that could extend out into whatever period. So if you're doing that for the current year, it would look like this. If you have non-constant growth, you have to factor in each dividend and then calculate the price of the stock, what it would be in that particular year, and you can use this growth rate model to do that. And this is the general formula for this using this approach. Well, you're going to calculate the price of the share using this formula, So whatever year it is, dividend whatever year it is times 1 plus growth rate divided by required rate of return minus the growth rate. So if you have erratic growth rates or you don't have income, you may use a benchmark price earnings ratio. And then if you don't have any income at all, if it's a startup company, you're trying to figure out what this company is going to be worth, you can calculate you can calculate the price of the share by using a benchmark price minus the sales ratio times the sales per share. And then finally, the required rate of return is dividends divided by price of the share plus growth rate. Now, when we talk about features of common and preferred stock, common stock is going to be the stock that has no special preference in paying dividends or bankruptcy. Shareholders have equal rights in the company through common stock. Typically, they vote with common stock for board of directors at an annual meeting. And there are two different ways that those votes can be acquired. There may be cumulative voting, which basically would allow a minority interest to accumulate a series of votes for one particular candidate for the board so that they could have a minority voice on the board. But they may also not have that. They illustrate that here. So if, for example, in this case, you have these votes and they're accumulating into one particular candidate. Now, with straight voting, you can't practice that accumulation. You basically have to vote. You have 20 votes, and you basically, based on whatever number of shares you have, you can't accumulate those into a particular candidate. But with cumulative voting, you can take the total number of votes and cast that for a single candidate, typically. And that's how they get a minority voice on the board. A minority shareholder voice on the board. Now, the problem with straight voting, minority shareholders are not always represented on the board. So there may be, in states, laws that permit cumulative voting. Proxy voting is where they give you a notice there's an annual shareholders meeting, and many people don't go to those meetings. Instead, they assign their proxy or somebody to vote in their place with their shares to somebody that they trust or maybe a group. This can actually be a strategy that some factions within the corporation or within the company use to get a particular candidate on the board, and there may be an accumulation of shares through proxy voting to basically voice maybe something that they're not pleased with the board, or they want a different candidate or whatever. Now, sometimes if it gets too nasty and they line up these proxies and they want to replace management through an election of a lot of directors or different directors. They call that a proxy fight, where you actually get people trying to accumulate proxies in different camps so they can win the vote for the board of directors. Stocks come in different classes, even in common shares. So you may have two different classes of common stock, and they give the example here. The Ford Motor Company has Class B common stock that's not publicly traded. It's held by the Ford family, interests, and trusts, and it has about 40% of the voting power, even though it represents less than 10% of the number of shares that are outstanding. So in that case, that's a separate class of stock. They also give an example here for Google. Similar thing, you have Class A shares held by the public, Class B held by insiders at Google. So that's not an uncommon practice, by the way. Any common shareholder has the right to share proportionally in dividends that are paid and the right to share proportionally in assets that remain after a bankruptcy or liquidation. They also have the right to vote on stockholder matters, such as a merger or board of directors or whatever. Typically done at an annual meeting of shareholders. And the dividends that they pay out, what are dividends? Well, dividends are essentially a designated portion of net income that are paid out to shareholders as basically a return on their investment in the company. They basically represent that return on the capital that they've invested in the business. A dividend has to be declared by the board, and once it is, then it becomes a liability of the corporation, and they must to liquidate. And then the payment of the dividends are not a business expense. These are really returns on the investment of owners. So that's really all that is. It's a return of their initial investment. It's actually not necessarily just a return on the investment, though. This is a share of the net income the business has earned distributed to the owners. So the owners are taking their money out of the business, or getting their money out of the business and sharing in the net income. Preferred stock is different from common in that preferred has rights over common stock, and basically they get first. Preference means that they get first. So if you are in a preferred class of stock, you're going to get your dividend before common shareholders get theirs. Also, holders of preferred stock often do not have voting privileges. That's the thing that they give up in order to get the preferred status. So they may have a stated liquidating value, and then the cash dividend is usually described in their share description. So here, for example, General Motors $5 preferred stock basically means that you're going to get a dividend yield of 5%. So essentially that's what that means. A preferred dividend is not like interest on a bond because there may be a time when the board doesn't want to pay dividends or can't, and if they don't pay dividends, there may be a cumulative feature in the preferred stock. It's not necessarily there, but it could be cumulative. If it's cumulative, what that means is the dividends are guaranteed each year to that preferred share, and if they don't pay a dividend, that then accumulates into the future, and so the next time they pay a dividend, if they skip a year, they have to go back and pay that year they skipped to the preferred shareholders, and then the current year before they can pay any dividends to the common shareholders. So they're basically in line in front of common shareholders. There's been an argument that preferred stock is a lot like debt, and it is in many ways because it's a predictable return. In recent years, preferred stock has had obligatory sinking funds. That's a lot like a bond issue. So basically it creates a final maturity because you may have a specifically stated final maturity value on the preferred shares. Preferred dividends are treated like common stock dividends for tax purposes. So these are not like interest payments, even though there are a lot of similarities. When we talk about the stock markets, most of you have heard of the New York Stock Exchange and perhaps the NASDAQ exchange. There are primary markets where people go to do an initial public offering where they, for the first time, offer shares of stock to the public, and also a secondary market where they trade between existing shareholders. So these are shares of stock that have been out in the market for a while, and they're not necessarily new. How does that work? Well, there are dealers and brokers typically that can handle these transactions. A dealer is somebody that keeps an inventory of shares of stock in hand or in their investments, and they can sell you a share of stock from their investment portfolio, or they can purchase shares of stock that you have for sale. A dealer is a lot like a used car dealer. A broker, on the other hand, does not maintain any inventory. They bring together the buyer and the seller, and that's a lot more like a real estate agent. They don't really participate in owning shares of stock. The New York Stock Exchange is the most recognizable stock exchange in the U.S. They used to own seats on it and before 2006, and in that time frame, the seats were very valuable, and the price has reached a record of $4 billion in 2005. Why so much money? Because it's a very lucrative place to be. It's a very valuable place to be, and there's a lot of opportunity here because there's a lot of trading that goes on in the New York Stock Exchange. However, they went public, they issued shares of stock, and now instead of buying seats, exchange members purchase trading licenses, but there's a limit to trading licenses to the original 1,366 members. Well, not the original members, but certainly those licenses can be purchased and sold. But now, if you went out, well, in 2015, if you bought a license, it's $40,000 a year. That's per year. That's not a once-for-all purchase. You're continuing to pay that. They also merged with Euronext to form an even larger international stock exchange. And with the merger, they were the first global exchange, so they basically handled stock exchange in Europe as well as in the U.S. And they also merged with the American Stock Exchange. It used to be called Amex. The American Stock Exchange, they merged with them, and they became even bigger then when Intercontinental Exchange acquired the New York Stock Exchange for $8.2 billion. I cannot imagine that much money. But that's November of 2013. They purchased the New York Stock Exchange. Now, you've all seen the advertisements for all the electronic trading companies that you can go to that offer electronic trading in the stock market. You can buy and sell that way. You may be buying and selling on the New York Stock Exchange, and if you are, there's still some very traditional things that happen. Typically, the people in the New York Stock Exchange have access to the floor where the exchanges are actually made. It's a physical location where they actually exchange orders to buy and sell shares of stock. There are pits where certain kinds of stocks are offered or securities are offered, and traders are there. Basically, three kinds of folks there. The designated market makers are the people that specialize in certain kinds of stocks. These people may have a focus in industrial stocks. They may be focused on the financial companies, or they may be focused on tech companies. So it's hard to say. They're going to be different people in different areas. Floor brokers are the people that carry the orders to these pits and make those exchanges based on what people want. It's still a physical exchange on the New York Stock Exchange, and it happens in multiple locations, not just the one you see on TV. And then there's the supplemental liquidity providers. Supplemental liquidity providers are investment firms that are active participants in stocks that are assigned to them they basically make a one-sided market. They offer to either buy or sell, and they trade purely for their own accounts, the ones that they have, and they use their money so they don't represent customers. These are not people that are going to be dealing commercially with anybody outside, but they are dealing with their own investments or their own shares. So those are folks that are in the New York Stock Exchange as well. So when we look at those and when we think about those, that's basically how that works, how the New York Stock Exchange works. You can do a virtual tour if you want right here. Very interesting stuff. The NASDAQ operations are a little different, well, a lot different actually from the New York Stock Exchange, simply because they don't have a physical location. The NASDAQ used to be known typically as over-the-counter stocks. The National Association of Securities Dealers Automated Quotation System, NASDAQ, is basically what that stands for, what NASDAQ stands for. But it's a computer network of security dealers who basically issue stock prices or quotes to the subscribers, and then those who subscribe can buy and sell on the exchange. Basically, NASDAQ completed a merger of its own with OMX, and now it's NASDAQ OMX Group, although it's simply referred to most often as NASDAQ. And in the past, it's been often suggested that the NASDAQ market had smaller startup companies, and it may have those as well, probably more so than the New York Stock Exchange, but it does still have a large number of very established large companies on the exchange, like Amazon, Microsoft, and Intel. Those companies started on NASDAQ but chose to remain there, not to move to the New York Stock Exchange. Basically, it operates on three levels. One is designed to provide timely, accurate source of price quotes, and those are available on the internet. You can get those anywhere. Level 2 allows users to view price quotes from all NASDAQ market makers. This allows access to inside quotes. So inside quotes are the highest bid quotes and the lowest ask quotes for NASDAQ listed security. Level 2 is available on the web, sometimes for a small fee. And then level 3 is for the use of market makers only. This is not for the general public. This is for NASDAQ dealers to basically enter or change their price information or quote information. So that's NASDAQ, and then they talk about electronic communications networks, and basically these are websites that allow you to trade directly with one another. Investor buy and sell orders are placed on these networks and transmitted to NASDAQ and displayed along with the market maker bid and ask prices. So ECNs open up the market quite a bit. These are like things that you see for basically where you enroll in a service and you are trading and buying and selling your own securities, basically. It's kind of an over-the-counter electronic trading process. By the way, in all these markets, they have computer monitoring to watch out for suspicious trading activity and to identify insider trading and so forth, if that is going on. You see a lot more information here. They give you about stock market reporting, pricing, how that appears. So that's really it for Chapter 7. Now I want to get down here to the questions for Chapter 7, because you got two questions you need to answer. One is stock valuation. Why does the value of a share of stock depend on dividends? And then the second one is a substantial percentage of companies listed on both exchanges that we talked about don't pay dividends, but investors are willing to buy shares in them. How is that possible, with given your answer to the previous question? So this is really just asking you why people might buy a share of stock without having any opportunity for dividends. Anyway, that's it for Chapter 7. I'll have the Chapter 8 video coming up shortly, but that's it for